first before we jump. There we go. Gage got it recorded. Excellent. Well done. All right, so let's talk a little bit about, by the way, before as we go through some of the messaging that I prepared, at the bottom of the screen, you've got a chat button. Feel free to use that, and we can stop and pause and take a look at your question and try to attempt to answer. If the question I can't answer, then certainly Gage or other advisors that are online, or let me invite you to also join in and participate with us today. We're glad you're here. So let's jump in to the economy. How in the world do you talk about the markets without talking about the economy? And this week was no different. October's been no different than any others. Our markets are volatile, but there's a lot of things that are driving that volatility. I wanted to touch on three key points. The first one is talking about something that has direct tie to interest rates, and that's the 10-year treasury yield. And a lot of folks, they just go, oh, don't even, if you start talking treasuries and yields, that just goes right over my head. Let's peel that back and just understand what it is. It's really 10-year notes issued by the federal government to institutions that then turn around and package those to the secondary market or to consumers. There's a rate of return on the coupon payments in which a consumer receives on that treasury bond or that treasury note. That's usually 10 years. It is fundamental in what the markets look at to see what is happening with interest rates in our overall economy. So write that down if you would, a 10-year treasury note or 10-year treasury yields. Today's yield is sitting at 1.6%. Well, what does that mean? Well, over the last couple of quarters, treasury yields have been inching up. That's a sign to economists and to the broader market that there's a chance that rates may be going up in the near future, making it more expensive for you and I to land mortgage rates or to get a loan at a bank, or for a business to issue notes or to borrow from a bank. So that is concerning to economists. Now, we've kind of stabled out around 1.6%. That's a good thing. Keep an eye, though, on the 10-year treasury yield. You can type it in Google, watch it. If it goes above 1.6 and you see that it's inching up, that's something that our economists are watching very, very carefully and making sure that interest rates remain contained and managed. The second thing I wanted to mention, this one is a no-brainer for all of us, but inflation. It was announced that in September, inflation rates are at 5.4%. That's on an annualized basis. 5.4% is significantly higher than we've been in the past. And so they are watching that closely. Well, what ties into or what creates inflation? Well, certainly COVID had a major causation and effect in what's going on in our economy right now. The Fed has printed more money in a short amount of time to stimulate the economy and to allow us to get the economy going. Certainly, there are more social programs. There's been more government spending. A lot of those things are driving where we find ourselves with inflation. So I'm going to touch on that and kind of wrap this up here in a second. So interest rates, inflation, and then the one that really got a lot of press this week, which was GDP. So what in the world is GDP? Well, think of GDP as just the output in our economy. And the key drivers, there are four key inputs in GDP: consumer spending, government spending, investment, and then what is called net exports. And so think of it as trading goods and services, what type of activity is happening in our economy. Well, the estimates for our GDP in the third quarter was 2.6%. Well, it came in at 2%. Which was less than they anticipated. Well, you may look at that and say, well, we're producing less than was anticipated. Yes, and I think that actually in today's economy is a good thing, especially when you pair that with inflation. So GDP is something that is extremely critical. Now, why in the world did GDP end up lower than anticipated? Well, it meant that the effect of COVID and the effect of government spending was less than they anticipated. So government spending on grants to local and state governments, interest-free loans to businesses, those kinds of things were less than they anticipated. The second one is just consumer spending. During COVID, the economy has slowed. And so, especially during the third quarter, during the Delta variant. And as a result, what has happened is that GDP came in less than anticipated. Now, that is kind of a negative sign to the markets, but what then has been happening in our markets over the last week? You may have seen this morning. In fact, I checked out Yahoo Finance this morning, and the markets were down. Futures were down, and the market opened down, primarily because of Amazon and Apple. They're having a difficult time with supply chains and the effects of COVID. So as a result, and one other thing I'll mention is employment. So those three things in combination, that those employment wages are higher to attract workers, supply chains are tied up, and with all that kind of pulling into at the same time, Amazon and Apple missed estimates for their earnings in the third quarter. Now, even with those two negative news, Ford came in, Merck came in, Caterpillar came in with record profits this quarter. And generally speaking, about half of companies in the third quarter have announced their earnings, and the vast majority of those companies have beat estimates that are publicly traded. So that is good news for the markets. That is why the markets, I wouldn't say they're on fire, but I would definitely say that they are humming at the moment. We're seeing records on the Dow, the NASDAQ, and the S&P. So broad-based market increases and stock price appreciation across the board. And I think what that speaks to less than that the effects of COVID in the second quarter, that they are looking ahead. The market is staring straight ahead, and they're saying, you know what, the future looks good. Although we are seeing that some stocks may or may not do as well in the fourth quarter just because of supply chain issues, but longer term, and that's what the stock market looks at, they look at the future and they look at where we are going in our economy, how companies are what the forecasts are for growth. And it looks bright, and especially in that earnings are coming in better than anticipated this quarter. So that is why, if you click on finance.yahoo.com, what you'll find is that the markets are up, and they will continue to go up as long as things look brighter. And so that means, now let me circle back to the economy. These things are critical. We've got to keep inflation in check. So what are they going to do, for heaven's sake? So as we look ahead in our markets, anticipate the following things. First one is that the Feds are going to start what is called tapering, or they're going to slow the amount of buying of bonds and issuing cash into our economy. So what that is going to do is start to slow the growth of them interfering, if you will, in monetary supply. So there's going to be some tapering that's going to happen over the next, in fact, things that I've been reading is that they're going to announce it in November. The second thing I wanted to mention, though, is that if increases in interest rates are going to happen, believe you me, that the Fed is going to give us very clear heads up that it is coming. They're not going to surprise the markets, and by launching and increasing interest rates, they're going to really airmail it and give us clear direction as to where they're heading. Now, so what is the quandary that the Fed is in as we look at markets and we look at the economy? Look, they're in a really tight quandary at the moment. They're in a conundrum. The reality is that they've got to keep. They are still working on unemployment, and so as a result, if they raise interest rates too fast and try to keep inflation in check, they are going to dampen the goal that they have, which is full employment, which is at 5%. And so there is this constant balance that they're going towards. Do not anticipate a whole lot of changes until the end of 22. We're going to see an increase in interest rates, but I don't see significant increases until the end of 2022, even moving into 2023. So the next 6 to 8 months are going to be interesting to watch this balance between unemployment, inflation, and interest rates. And they've got to keep all those in balance, but their real primary balance goal right now is unemployment. They do not want to raise interest rates too quickly and then negatively impact encouraging businesses to grow and to create more jobs. So that's kind of where we're at. Where are we heading? I think the markets still look good. Expect volatility. There's, the reality is that we visit every day with clients that are coming in, and there are some things that we can do to stabilize or to reduce the volatility on your investments. If you're concerned about that, give us a ring. Let's talk about it. Let's make sure that you're taking advantage of safe, guaranteed investment positions. But at the same time, you're also taking advantage of low market risk positions. There's really no need to ride the market roller coaster up and down unless you prefer that in some of your accounts. And certainly we can do that, but it's not needed. And if it causes you angst or worry, then let's make sure we sit down and talk about these things. All right, I'm going to shift here for a second. I'm going to share my screen, see if I can do this. Let's now shift to, see if I can pull this up. All right, let's shift to Medicare. Hopefully you can see my screen. All right, so let's talk about open enrollment. What in the world is open enrollment? Well, it's the opportunity for you to select which Medicare options that you want to use for this next year, for those that have already enrolled. For those that are new, there's an opportunity, and let's talk about what that timeline is for you to enroll. So open enrollment starts October 15th and goes through December 7th. Be sure that you're covered for 2022. The second thing I wanted to mention is that if you are new to Medicare, open enrollment, you have 3 months before the month of your 65th birthday, or you have 3 months afterwards in which to complete your enrollment. One major decision factor in deciding which option in Medicare you're going to choose is really tied to your budget and what you're comfortable assuming, as well as your health status. So what I wanted to do now is just take a minute and let's talk about the different parts of Medicare. And I'm going to use my whiteboard here to do that. My writing's not very good, so be forgiving. But let's talk about what in the Medicare world is called original Medicare. So that includes Part A and Part B. So what is Part A? Part A is, if you think of hospital, anything tied to hospital, so hospice, in-home care, those types of services are included in Part A. There is no cost for Part A. Keep in mind, though, that the deductible for Part A is certainly nothing to quickly glance over. It's $1,488 as a deductible. So just keep that in mind. There are deductibles, but there is no monthly cost for Part A. When we talk of Part B, we're talking about doctor visits. And doctor visits include outpatient, it includes physical therapy, it includes any kind of equipment you may need, like wheelchairs, et cetera. There is a cost for Part B, and it's currently $148.50 per month for most of us. Now, I need to state that the premium, I want to give you exactly what the numbers are. I'm not going to run through all these, but just note that that is for individuals that have less than $176,000 per year in modified adjusted gross income. So 176 or less for those married filing joint. For singles, it's 88,000 that your premium for Part B will be $148.50. If you make more than that, there's a scale that goes all the way up to an additional premium of married filing jointly, and for singles above 500,000 of 504 additional cost in addition to the 148.50. So just be aware that is why we talk significantly about retirement income. because we try not to add income to increase your premiums on your Medicare. It's a huge consideration. One other point is that Part B has a deductible of $203. In addition to that, 80% is what is covered with Part B and Part A. So 80%. So that leaves this bogey out there of 20%. What do I do if I want to cover the additional 20%, especially if I don't have the best care or the best health in the world? So let's now talk about, if we draw this line between the two, you really have two options at this point. You can do what is called a Plan C, which is Medicare Advantage. Now let's talk about what Medicare Advantage is. The other option, by the way, is MedSup or Medigap plans. So if you hear of MedSup or Medigap, that's on this side and Advantage is on the other. When I think of Advantage, I really think of an HMO plan. It's restrictive, it's more narrow, and their whole design is to control costs. So what's included in Advantage? Well, what's interesting is it does include all of Part A. It includes Part B. And I'm going to add, before I go further, when you hear of Part D, think of drugs. So the Advantage plans include A, B, D, and also include dental, vision included in their plans. There frequently is no cost for these plans. Now, for those that are in Texas, I just want to add that, just because that's the hat I wear most of the time, is that in Texas, the average Advantage plan is $22 a month. So it's going to be quite affordable, but either no premiums or somewhere in the range of $20 to $40 a month. So what is critical here is that you can get this Plan C and for a small premium, but controlled care, you can also get Part A, Part B, and Part D. Now, you also need to take advantage of enrolling during this period, right? In the Advantage plans. So what then over here is MedSup. Now keep in mind, what we try to do is to close that 20% cost gap that was created up above. So MedSups or Medigap plans do just that. Think of a PPO or a preferred provider, a broader network than you would get with an Advantage plan. There is a cost associated to these plans. If they're going to pick up the remaining 20% of your care, there is a cost. And the cost usually comes in at $85 to about $150 a month. I also want to mention here on these type of plans, if you miss the enrollment window, plan on having to go through underwriting. That's one of the drawbacks on these plans. So underwriting is potentially something you're going to have to go through in case you don't participate in the open enrollment period and you miss that window. But lastly, I guess I want to mention what's included and what is not included. It does not include Part D, and it does not include dental or vision. You must buy those separate. And so that's an additional charge or an additional cost on top of the $85 to $150, depending on what option you select. So we get this question a lot. If 40% of folks are going with Advantage, meaning 60% still use MedSup or Medigap, what's the advantage of either? Here's just kind of a quick and dirty back of the envelope suggestion I would offer to you. If you have generally good health and you want to reduce your costs, then the Advantage is frequently the route you want to go. If you're concerned about your health and there are some things that you want to address and and cost is not a concern, then clearly a MedSup is the direction you want to go. Especially if you have a specialist or somebody that you use on a regular basis that you have a relationship with, that is providing you specialty care and is giving you the help and the counsel you need today. It may not be worthwhile to save that extra money to just stay with MedSup or Medigap plan and to go that route. So those are the kind of options you got there. At the end of the day, we are investment advisors. We do have relationships with Medicare professionals, both here in Texas and New Mexico, as well as across the Southwest. Be sure to reach out to us. We're happy to point you their direction. They'll be able to lay out all the plans in your local market and to help you make some important decisions. Healthcare obviously is one of the critical 5 areas that we as advisors counsel, right? We focus on income, investments, healthcare, taxes, as well as leaving a legacy. So healthcare is something, although we don't necessarily, dive as deep as those that actually recommend healthcare plans, we can certainly guide you to those that can answer your questions. So I've kind of cruised through this information pretty fast in these 20 minutes. I know that there's a lot more information that we could share with you. Go ahead and schedule some time with us if there's some questions you have about Medicare, about your taxes, about investments, about any social programs, Social Security, or any legacy type issues. Schedule some time with us. Let us go through those. And if you have any questions about the economy or about the markets in general, be sure to reach out to us. There are clearly some things we can do to help. If markets make you nervous, there are some things that we can do to offer safe guaranteed positions or low market risk positions that may be of help to you as you prepare for retirement or in your retirement years. So that's all I've got. I wanted just to keep it simple, pretty short. If you've got any questions, feel free to hang out. And any of those of us that are online would be happy to answer them. Until then, we'll talk to you later. Thanks so much.